I think from my point of view, investing is about long-term returns. Okay, so I don't get caught up in the noise, which is that short-term volatility. So I still believe that, my superannuation, they invest in shares. I've got direct shares that I also invest in, and I also invest in property. So I think that diversification story is a good story to sort of lay out. What you've got to understand when you are investing in the stock market is that there is a lot more volatility.
Yes.
That is the big story here. So if your heart can't take the fact that since August the share market's been down between 10 to 12% in effectively a couple of months, and in days billions of dollars can be wiped off the share market, then maybe property, bricks and mortar, might be a better bet for you because it's not as liquid. Property is illiquid, which means that even if there is a bit of fear in the marketplace, it takes time to transact. So we don't have that run-on effect that we do have in the stock market when everyone starts to panic.
The big thing that happened when GFC hit was that Australia in particular was quite strong because, as differently to the rest of the world, in America, for example, large companies own large amounts of shares of other companies, whereas in Australia, typically, and that might be changing, lots of chunks of shares were owned by lots and lots of mums and dads who didn't sell, so we didn't have that same fall. What do you think about that?
Well, I think there's a couple of stories there. One is that a lot of people don't realise that most American companies don't pay dividends. Okay, so you go into the market to get that share growth, that share value, so they trap that profit and reinvest that, or store it, as Apple does, literally $80 billion in cash. So those types of businesses, you're trying to buy growth. So it's all about growth. Whereas in the Australian share market, we have growth assets, but we also have some yielding stocks as well.
Yeah.
Now, when we do see a big correction, we do see some of those yields get affected. Now, when we switch over to property, we are talking about, it's a single asset. Okay, it's an essential need, shelter, and usually, depending on what market you're in, usually you get really strong occupancy rates. So you normally get an occupancy rate over a long period of time of around 95 to 98%. So you're sort of guaranteed that rental return. So hopefully you're getting the capital growth, but you're also getting that rent coming in. When businesses start to struggle, they don't necessarily pay those dividends and those distributions. So all of a sudden, what you are counting on as being supplementing, your retirement savings and so forth, you may not get that. So that's what a lot of people have got to work out in terms of when they're about to invest. They should seek professional help and try and understand the pros and cons of both marketplaces.
Yeah. Ben, a big topic of conversation at the moment, given that the share market falls, is how to protect yourself, where to go. And there's been a lot of talk about sort of keeping some cash on the side or even investing in gold or property because of those less risky investments. How would you protect yourself in the property market? How would you sort of avoid losing money, I guess, in a market like this?
Well, I think first of all, you've got to buy right. It's pretty much the same as the share market. I don't buy the share market. I buy companies. Businesses that I'm really hoping will do something, that have a competitive advantage, a moat, a point of difference. And I look at their return, their PE ratios, and I look at that. When it comes to property, I'm doing exactly the same thing, but I'm looking at owner-occupier appeal. I'm looking at buying in areas where there's not a lot of vacant dirt. I'm looking in areas where it's hard to deliver oversupply into the future. So usually that's my insurance policy in terms of getting in. Now, let's say I did get in and the marketplace has corrected. I'm still taking a long-term view. This is a portfolio of properties that I'm going to build up over a period of 20, 30 years, and I want to live off that passive income. So that's what I was talking before. Even if you're not getting that capital growth, the renter is also supporting you in terms of servicing your debt, and eventually that property will become positively geared. I'll start paying my tax to the government, and I'll start living off that residual income.
I'm wondering how much the balance between this, investment in shares versus property has to do with your personal control. I can't control over this company, what they do with their products, their reputation, how they could be damaged. But I can increase the property value. I can mow my lawn. I can paint the fence and increase the property value. I sort of have more... Yeah, it's not bad, is it? I just pulled that out of my hat. What do you think about that?
It's a brilliant point, and it's one of the main reasons people invest in property. Control. Ultimately, they've got a say in adding value, topping up, renovating, those types of things. So that, as well as leverage in terms of being able to control a bigger value and getting a return on that, because I would not recommend anyone leverage into the share market. Too dangerous, margin calls, you know, you could lose a lot of money really quickly. Sensible leverage, which you can afford for the long term, allows $100,000 to potentially control, say, a $500,000 investment property. Well, I'm getting a return on the $500,000. So my cash on cash return is a lot more significant, even if I don't get the same percentage returns that I might do in the share market. So for me, that gives me comfort, and I'm in control. It's my asset. I'm ultimately going to be responsible for adding value and understanding the marketplace. And I'm hoping that everyone in the community that I've just bought in has a similar, you know, proudness of their homes and want to build up the area, and that add value. And obviously that's where I get my capital growth over the long term.
Ben, just to pick up on one of your points there where you were talking about being positively geared as one of the ways to protect yourself, I suppose. How likely is it that we come across those properties these days? Is it kind of few and far between that you can now be positively geared?
No, they're definitely out there, but you've got to remember that a lot of those properties are usually in regional areas.
Right.
So when we've got really low interest rates, your cost of money's cheaper, and if you're getting yields around 5.5%, they're usually going to be neutral or slightly positively geared. Now, when we buy into the bigger centres like Sydney and Melbourne, there's usually going to be a shortfall. So that's when we have to kick in that difference over that short period of time, until ultimately, you know, every 2 or 3 years, rents are creeping up, you're paying your debt down, and eventually that property does become positively geared. That's why, you know, negative gearing is not an investment strategy. If you're buying a property to negatively geared, you're dumb. You know, it's just not sensible. Ultimately, it's a moment in time, and then over the long period of time, it's going to deliver you passive income.
The other thing too, Ben, you know, with Empower Wealth, I know we used the analogy once in the past of the hare and the tortoise. So you really do more think like the tortoise, and unfortunately the hare's gone quick. Lots of money, sell, lots of money, sell. And the tortoise is going slowly. So people who are getting scared now of fluctuations in the real estate market around the country, as is happening with shares, if you're in and out for the quick money, that's going to affect you big time. But if your projections are longer term, it's quite different.
Yeah, well, look, I mean, I can transact a share for $10. Right, so it's quick, I'm in and out. But in terms of property, I've got 6% costs usually in terms of stamp duty, solicitors' fees, borrowing fees, those types of things. You've got to make that money back. And usually once you understand that you've got all this borrowing, if you've got to flip a property, you're going to be giving up a lot of that money. So you've got to let it breathe. I think it's like a great bottle of Cab Sav. I use that analogy. It's got to sit. You know, if you're going to try and drink it too early, it's not going to be good drinking. But if you leave it for 10 or 15 years, it's going to be beautiful.